this is where we start to get a bit trippy from a techie point of view. I'm not going to labor too much in about blockchain. I will make it an opening statement. This has nothing to do with cryptocurrency. Blockchain and the Internet of Things is the future of finance. You may choose to disbelieve that, but I hold it to be true. Because everything in blockchain, and the way it operates, the way it self-perpetuates, the way it self-protects itself, is a far more efficient system than the traditional mutual fund structure that hasn't really evolved for 50 years. So we have these various things. The block headers, the Merkle roots. The Merkle roots is almost like the rules of the blockchain. Every transaction is checked back against. Every transaction has to be spot on. If you create your fund or your portfolio using blockchain, as the block advisor and the fund selector, you could use something like Untitled or universal ratings to assess the complexity of your portfolios. Those who have studied complexity analysis systems, CAS, complex adaptive systems, will know that the rising amount of complexity within your portfolio is actually a rising risk within your portfolio. Where you might think you have diversification, you actually have potential for T1 correlation, delta 1 events. In times of stress, this is where you're going to suffer. It challenges the traditional optimizer, the capital asset pricing model, the Black-Litman's model, which is, look, let's just bunch a whole different types of assets based on a covariance assumption, and we'll get diversification. Well, I'm afraid markets have become too complex for that. Those correlations now are shorter lived than ever before. You need to understand interconnectedness to truly know when you're getting diversification or if you're just increasing the risk. Don't believe that financial markets are complex. This is the fund platform I look after in the UK. Every dot is a fund. I'm not expecting, maybe the actuaries are back in the room, they've probably counted how many there are by now. There's about 867 up there. You can't even see the outer perimeter in some sort of crazy Star Trek scenario of all these little funds are out here. The scary part is the lines are cross-investment between the funds. This is why I believe we need serious computing power to enable our jobs. And indeed, much is talked about AI or artificial intelligence. And what caught my eye was one report that forecasted that the global GDP effect of AI by 2030 will be an increase of 14%. What is that? That's 15.7 trillion US dollars. That is more than the combined output of China and India combined today. And what is changing the possible is nothing new within machine learning. It is differentiable neural computing, or DNC. Some of you might already be aware of what DNC is. We've all seen it in the news, but perhaps didn't recognize it. DNC powered a program called AlphaGo. It beat the best Go player from Korea in the world at that game, across 250 to the power of 150 possible moves. DNC creates digital wisdom. It both can read and rewrite its own memory. In this way, algorithms don't have to have every single outcome at inception, but it can effectively iterate and learn as it goes through. It's a fantastic way to scale literally hundreds of thousands of different algorithmic pathways in one program. Then you've got researchers at Microsoft and the University of Cambridge developing DeepCoder. DeepCoder is a type of program we call program synthesis. What it does is it's a piggyback program. You give it a problem, it goes onto the internet, and it will sweep literally hundreds of thousands of different algorithms to find a solution. It does it literally in seconds. And when you think, according to Stratified, there is 30,000 gigabytes of new data on the internet every second, then that's a lot to piggyback. So if you start to mate DNC with program synthesis, then you could create a neural architecture that would far exceed the objective judgmental decisions of a fund selector and would get us much closer to the subjective biases of the fund selector. Even as far back as 2005, Robert Ludwig and Michael Pavioso proposed a manager selection using 3 different types of approach: naive Bayes, neural network, and decision tree learners. And they found the results indicate that machine learners can be used as a decision support aid to improve the selection of money managers. In some respects, they were being polite because in the test experience, they had a large number of actually human test subjects as well, fund analysts. And the machine learners outperformed every single one of them. But fintech, can it actually challenge the core of the human-to-human relationship? Can fintech be good? Well, consider that Nietzsche said, there is no such thing as good. Good is simply the herding instinct of the individual. Or think that 200 years ago, the Scottish investment industry set down the bedrock for fiduciary. Ubere me fide, in utmost good faith, you'll recognize it. It's almost our mantra. It was written into those first actuarial contracts, those first Napoleonic bonds. So whilst good might infer that AI has to acquire agency or self-awareness, this is not true. We don't need AI to feel good about itself for being good. We only need AI to do good things. And Morningstar seized on this year, whereas these rantings of mine would be just the stuff of science fiction. Today, Morningstar launched Q Ratings. Now, Morningstar Q Ratings will probably go on to become the largest fund rating platform in the world. What Morningstar Q does is it takes the human mappings of its 180 global fund analysts, synthesized them into algorithms, and then created an AI machine learning fund rating platform. Where it gets tricky is, what Morningstar are going to do is they're going to apply that to every fund out there that their human analysts don't cover. Now, their human analysts only really screen about 10,000 funds out of a universe of 100,000. They only rate barely 1,000 of those funds. Morningstar Q will rate every other fund that's already available. Now, this sounds really good. If you actually look at the Morningstar PR on this, it's very harmonious. It's machines and people working together. It's the best of both. Until the Q ratings start to outperform your really expensive human fund analysts. Then you have a problem. Likewise, Larry Fink, much to the gall of his portfolio managers, has said that the future of active asset management in BlackRock is going to be his SEA quantitative group in the Bay Area in California, a black box asset management team. Indeed, it's not just words. He's already sacked 17 portfolio manager teams in the US and moved the assets to the quant model. Now, for those who are particularly interested in this area, I present a lecture for Fintech Circle Institute specifically on the robotization of mutual fund selection. In there, we'll examine a number of quantitative and qualitative techniques of how we go about selecting fund managers, and we'll also go through about a dozen different types of algo mapping and how you could actually then use that, apply it to your own portfolios. But AI does face a number of challenges. Firstly, those protections need to be hardwired, outcomes monitored, and the programmers regulated. Indeed, in the UK, the FCA, in its consultation, CP 1725, has done exactly that in its new certified regime. Algo programmers now in the UK will have to be certified if the algo program is running customer assets. And at least Robo can start with the 3 laws of Asimov. otherwise known as the 3 laws of robotics. Rule number 1, the robot can't harm the human or through an action allow the human to be harmed. Rule number 2, the robot must do what it's been told by the human unless it contravenes rule number 1. And rule number 3, the robot must protect itself. And you guessed it, unless it contravenes rule number 1 or rule number 2. And this won't be easy, because what I see particularly in big finance is that finance professionals don't understand code, and coders don't understand finance. So tomorrow's finance professionals, tomorrow's fund selectors will understand the balance of both coding techniques and finance. It is here where I believe small boutiques and startup fintechs can work together to find those new solutions, unencumbered by their legacy ways of working. For example, if you mash up blockchain with AI, you could do some fairly interesting things with an exchange-traded fund. You could actually start to involve adaptive trading across thousands of assets. You could literally manage thousands of individual investor pathways through their journey. It would allow cross-investment between the investors, frictionless, devoid of tax, super efficient. In doing so, you would utterly compress the cost of investment. You could use what already exists, efficient electronic trading platforms and pricing mechanisms to ensure efficient mark-to-market outside of the blockchain and indeed inside. Then, suddenly, passive becomes social. Benchmarks, clearers, market makers, index providers suddenly become meaningless. As an advisor, you could literally advise all of your investors according to their each individual needs within one single mega block. This is an entirely new way of thinking of how to pull investors together. In there, you would have an algorithm mapped for every single investor to understand their needs, their maturities, their cash flows, to understand every single trade would be coded for purpose, specific to each investor. Your Asimov test becomes your safety net. It ensures that the algorithm constantly checks itself, so it's in line with the needs of the investor and your risk-stated aims. Now, this all feels a world away from finance today, so I appreciate that. Yet, in many ways, the old fund order is already dead. It just takes a long time for the nerve endings to tell the central brain. In the meantime, globally, large, creaking, free-float passives act as a methadone for the masses. And whilst Karl Marx could not have possibly anticipated the fourth industrial revolution or social media, his words today resonate more 200 years since his birth. Division of labour, machines, rising competition between humans, humans becoming displaced in the capital model. And so, I turn to you, dear friends. I wish you well as Godzilla approaches. To survive, we must evolve. In the new fund order, the case for multi-boutique, in my opinion, is compelling. A balance of economies of scale, yet technological scalability. Less human intensity. So consider engaging fintech. Consider agile boutiques over big AM. Better efficiency. Embrace new tools. Learn new skills. Integrate machine learning into your processes. Control your future. Build trust. Become cyborgs. The new fund order has just begun, and don't worry. Be happy. Thank you very much.